So, thank you all for joining on this Saturday morning. So, the topic for today's webinar is why good portfolios underperform temporarily and why that's completely normal. So, the reason for me to do this webinar is mainly because a lot of things are happening in the market right now, in Indian market especially, and things aren't going good, especially in the last 18 to 20 months, almost the last 2 years. Uh, Most of us haven't made returns because equity markets didn't move at all. It's completely flat. So a lot of people of us will think that we could have stayed in FDs itself. And even there was a data that in the last 3 years, SIP returns was absolutely zero. So in times like this, we generally doubt our trust in equity markets. We generally doubt our investments, whether it's good or not, whether we should stop it, whether we should sell it and move back to FDs. So a lot of things will be running in our mind. Whereas on the contrary, the international funds, the international markets, the US markets, the Korean markets, the Taiwan market, these international fund markets are doing extremely well, and things are euphoric there, just like how things were euphoric in Indian markets in the last before 2 3 years, like how a lot of IPOs are coming, and the same things are happening in the international markets now. And we all know that when times are euphoric, that's when you need to be stay cautious, and when things are looking bad, that's when you need to actually have confidence and invest in the right places. So this is just to give that confirmation and that reaffirmation so that you gain confidence. So that's why I just decided to do a webinar in this topic. So now let's get into the webinar. So I'll just give a quick overview on the basic myths and the paradox. So generally, we all think that in the short term, uh, I mean, in short term, we all feel like large cap funds doesn't give any returns, whereas your small and mid cap funds will do absolutely good. But whereas at the same time, whenever there's a market correction, you'll experience a very steep correction in mid and small cap segments, just like how it was in the last 2 3 months. Most of the stocks even corrected by 30% in a single month, right? So you need to stay cautious. So sometimes the decisions that you take in the short term, it might look bad. You might doubt yourself, but in the long run, it absolutely makes sense. Yeah. And you will also feel like, if you have a concentrated portfolio, you will feel like the returns will be more. But whereas at the same time, in a concentrated portfolio, during the correction phase, you might experience a steeper drawdown than a well-diversified portfolio. So, diversification and allocating to the current market segments according to market valuations would be the right choice and would make the right sense in the long run. Maybe in short time, maybe you will feel like you've made the wrong decisions, but during underperformance. But in the long run, you will feel like you made the right decision. And sometimes we'll try to compromise ourselves and we'll try to chase the hot sectors, the momentum funds. So, when markets are euphoric, maybe you just to get that extra 10 20%, you might even risk of losing minus 30%. That has happened actually. At the extreme top, it has already always happened. So it's better to stay disciplined and invest in a very long-term mindset with a valuation discipline principle. And always, when you think a lot about it, we'll actually make the wrong decisions, and we'll try to sell the good investments. And once we've sold, after a couple of months or after some time, they will start performing, and your portfolio wouldn't have that particular mutual funds or stock, and then you will actually worry about it, right? So you don't need to overthink a lot. So you just need to, make sure that you invest in a bad market when things are not doing good. So that's one thing. So the main thing is, like, if you want to make good returns, you need to invest when times are bad. And right now times are extremely bad, right? So the first thing is you need to invest when times are bad. And second thing is you need to invest in the right and good quality investments when things are bad, right? If these two parameters are correctly followed, right, I think definitely in the long run, you'll make good returns than the benchmarks. That's for sure. And yeah, so in the long run, the good, correct principles that you need to follow is you need to diversify your portfolio so that during market corrections, your portfolio doesn't experience a very steeper drawdown. And the second thing is you need to disciplinely continue your SIP. You don't need to doubt yourself when things are doing bad. And like I said, if you think a lot, you will rebalance a lot, and that will actually, uh, compromise on your overall returns. And yeah, you need to invest in the right, good quality investments when markets are going bad, and you need to consistently continue your SIP so that you build a real wealth in the long run. Yeah. So, and I just want to end this slide by uh, quoting Benjamin Graham's quote is that investing is not about beating others at their game. It's about controlling yourself at your own game. So you need to, you have a goal, and you need to, like, know what kind of funds will suit you and what kind of risk that you're willing to take. And you need to select the funds based on that, right? It's just like how we are riding a bike. So some people want to ride a sports bike. So if they have the talent and the skill to control the speed, then they can go ahead and ride at a 150 kilometer or even 200 kilometer. But if you don't have the control, then you need to, drive at an average pace so that you go and reach the destination and in a very safe way. So again, I just want to give the main reasons why there is some underperformance. The first thing is market cycles. So every market cycle, there will be a phase where the the markets are going very high. Things are very euphoric, and then there will be a phase where there is a downturn, and then there will be a phase where things are in an accumulation phase, where things are going, in a sideways or range bound market. And then uh, once again, the next cycle begins and the markets begins to go up. So we need to understand where we are in the market cycle, and we need to, work on how to allocate between segments. So you need to see where, in which market segments the valuations are quite cheap and attractive. So, you see the large cap segment, right? Large cap hasn't really made much returns in the last 5 years. If you say most of the Nifty 50 blue chips, they haven't delivered significant returns in 5 years, right? So at this time, large cap looks very, very cheap, whereas mid cap looks quite expensive, and small cap is expensive, but not as much expensive as mid cap. And yeah, but still small cap and mid cap has a lot of risk, and it has some more correction to happen as well. So at this point of time, we feel like large caps have a better run and better chance to, provide in terms of returns and safety. I mean, what I intend to say is that they have a better risk reward. Yeah. And the second one is, like, SEBI has categorized a few mandates, right? Let's say, for example, if there is a particular thematic fund, the fund manager actually has to, replicate a quite a bit amount of, the index, the particular index. So at that time, if the index has some overvalued stocks, the fund manager is also forced to buy those stocks at a certain level, to certain extent. So at that time, due to the particular stocks, that fund might underperform. So this is also one of the reason. Yeah, and it has happened even in consumption side. So in consumption, like, we were positive in consumption. We still are, but let's say even our clients generally raise some doubts. There are particular stocks which are very, very overvalued. Why is it in this fund? So our reply would be that it's because the fund managers is forced to buy those stocks because the index also has. And the third one is there is some underperformance mainly because due to overall macro and RBI interest rates and their policies, right? So like at the moment in Indian markets, like what you say, uh, like the rupee is depreciating and the FAs are actually moving out. They're selling crores and crores, thousands of crores of money day in, day out. And actually, money is going to emerging markets in terms of Korea, Taiwan, US. And these things are indirectly and directly affecting Indian markets, right? So even if you select good quality investments at this time, markets aren't moving anywhere. So your portfolio would be underperforming. And finally, fourth one is benchmark mismatch. Sometimes, let's say it's because of our lack of awareness that we might invest in an equity fund, or you might be investing in a BAF fund or a multi-asset fund, and you might actually see the benchmark as a Nifty 50 or a Nifty NSE 500, right? So you need to see the correct benchmark according to the kind of investment and the fund you've chosen. And finally is it's mainly because of recency bias. The recency bias is that once you start experiencing things, right? Let's say for example, when at November 24, just to give you an example, November 24, markets corrected by 15-20%. But a lot of us thought that after September, still the bull run would continue. And after that 15-20% correction itself, a lot of people jumped in and they invested and they went all in. But once at that point of time, if they're all in their money, still those people would be sitting at a loss, and those people wouldn't have made any money. So it's recency bias, thinking that the same things will keep on happening again and again and again. So that's one thing. So we need to avoid this bias and NFO mania. So generally, you need to like a lot of people, like follow the hot trendy stocks or the hot trendy sectors. They want to invest where there is always a bull run happening. So they just, a lot of investors, right? What they do is they just keep chasing. So 2024, 2023, 2024, they were chasing small caps. And after 2025 to 2026, they were chasing gold and silver. And right now they're chasing the international stocks. So whatever is trending, they'll be chasing, right? So what you need to, stay invested before the trend actually begins. So that's the way to make money. And for the trend to start and the once there is a gap between uh, like when you're investing and once it skyrockets. So this gap is actually the time where things are not going good. You need to endure this phase actually. So this phase is called as underperformance, right? Let's say for example, just to give you an example, gold and silver. We were actually investing in gold and silver from 2021, and even in 2023 we were investing, and even in 2024. The recent last year budget, when the finance minister like cut the import duties on gold and silver, right? Even on those days, gold and silver actually corrected a lot, and even in these days, we were actually buying gold and silver a lot. But at those times, nobody were ready to invest in gold and silver. Like a lot of people were thinking that I need to make money. I need to make money only from equity. So they thought, why I need to invest in gold and silver? But once it started skyrocketing, right? Most people were even ready to sell their properties and invest in gold and silver. But now, like they would be sitting at a loss because the rally has almost been completed, right? So you don't need to chase things. You need to find the right ideas, and you need to sit tight. Like it will take one year, to take off, right? So this endurance phase, this underperformance phase, is definitely indispensable part. You can't avoid it, right? So these are the things mainly why there is some underperformance happening. So this is just a chart of the Nifty in the last almost 20 years, how every year the Nifty has gone up and down on a yearly basis, and how a flexi cap investment has also given. So the blue bar is Nifty, and the orange bar is the flexi cap. And if you see one significant major drawdown is 2008. And 2008, due to the financial crisis, Nifty even corrected by 52%. And the next year, you see the next very same year, the markets soared by 76%, right? And if you see, the common thing is that if in the last 18 months, wherever Nifty hasn't given any returns, the next 1, 2 years, the Nifty has absolutely given better returns, right? So you need to invest in times where markets are doing bad. So yeah, so like I was saying, every crash feels like this is the end, but it's not the end, right? So these are the one of the significant corrections which has happened in the last 20 years, where Nifty has corrected by more than 30%. Yeah, so the first one is the dot-com bust and the Cargill war aftermath, where Nifty even dropped by 50%, but Nifty recovered the next 3 years by 72%. And like I was saying, in the Lehman Brothers crash, 2008 financial crisis, Nifty corrected by minus 52%, and the Nifty recovered by 76% in the next very same year. And 2011, there was a euro crisis, and INR was depreciating, and the Nifty corrected by 25%. And the next year, Nifty gained 28%. And in the COVID, same thing happened. So on a single day, like market crashed by almost my minus 38%. But by December 2020, the Nifty hit an all-time high. And same, in 2022, the FA sell-off was happening, the rate hikes were happening, and right, and the Russia-Ukraine war was happening, and Nifty corrected by almost 16-17%. And in 2023, it almost gained by 20%. And in 2024 also, market gave good returns, right, until September 2024. And it's not the case for just Indian markets alone. Even Nasdaq 2022 correct, Nasdaq, the US markets corrected by 50%, right? But after that, it almost gave 100% in the next 2, 3 years, right? So whenever things are brutal, when like Warren Buffett says, the best time to buy is when there is blood in the markets. So this is an illustration on how the typical a retail investor or how a new investor without awareness behaves. So basically, they start investments once markets have started rising, right? And once the portfolio goes up by 20-30%, they're very excited. They're ready to put a lot of more money at that time, right? And once the correction begins, slowly they start panicking, and the portfolio maybe is down by 20%. They start to, stop their SIPs. They start to redeem their money. And at this point, they're not ready to put more money, right? And once the market recovers, they'll be in a FOMO. They'll try to re-enter that point of time when markets have already started to come up. And once the all-time high begins, they're ready to put even more money at that time. The same things keep happening again and again and again. And the investors who stayed invested during the correction phase, and investors who you know put more money, they would have made good returns. Money, and if he had kept coming in and out and in and out, he would have actually made lesser returns than the person who stayed invested, even though they've invested in the same fund, right? So whereas the good investor, like, would have made 14-16%, just like how the Nifty has delivered whenever there's a correction. And these average investors will be, would have got only 5% CAGR. So this is the behavioral gap between, the actual market returns and the individual investors' returns because of the mistakes, right? So these are just common misconceptions, and we'll just let reframe like how your thought process and how our thinking is, and how we should need to reframe those thinking, right? So generally, we think that my fund is underperforming the Nifty. Maybe I should switch. But what you need to see is that what fund you're holding, right, and what your goal is, right? So you need to make decisions based on that. because if you keep on switching in and switching out, and if you keep on riding funds, right, then you'll actually be incurring a lot of losses. There will be exit loads and stuff like that, right? So you'll actually be losing money. So you don't need to do that. In terms of mutual funds, one thing which we are very sure is that even a very poor mutual fund has actually given positive returns in 7 years. There is no fund which has delivered where if you've invested, yes, if you've stayed invested for 7 years, there is no fund where you would have made losses, right? So if you take the time and effort to invest in a good mutual fund, right, definitely in a very longer time frame, you will do better, right? You will get the chances of you getting a double-digit return is very, very high, right? So you don't need to, keep adjusting your portfolio very often. And stopping SIPs and daily checking the NAV of your mutual funds is simply not right, because you need to actually see the fundamentals. Maybe you can look at the fact sheets once in a month or once in 3 months. You can check what stocks have gone out, what stocks have come in, what stocks they've reduced the exposure, what stocks they've increased the exposure. You can see what the fund manager's thoughts are. Maybe you can check all these things. You can check the fundamentals, but simply checking the NAVs doesn't make any sense, right? And another thing is, you don't need to always chase the hot sectors, hot teams. You don't need to invest in NFOs. NFOs really doesn't make any sense because NFO, the initial 10 rupees doesn't have any underlying justification of value for the 10 rupees. Initially, once, you know, based on the stock's performance, the 10 rupees will keep going down or keep going up, right? So you can wait, even if it's a good team, right? Because there are a lot of NFOs launching on the futuristic teams, right? But a lot of people think that futuristic teams have better scope, so they directly invest in an NFO. And NFO, the initial 10 rupees that they come in, it really doesn't have a value or justification. Which is happening right now. FAIs are selling, they're investing only in out of India. So we will wait till for the FAIs come back, right? But it's really not, it really doesn't matter. I mean, it does matter, but you need to make sure that uh, you're staying right your goals. Let's say you will be having a 1 crore or 10 crore goal which you want to, you know, uh, achieve in 10 years, 15 years, or 20 years. You don't need to worry about returns when markets are doing bad. Returns will come, it will eventually come. You just need to stay true to your commitment that you've decided to do in terms of SIPs or lump sums, right? So if you disciplinedly do it in the correct funds, then definitely you'll definitely reach your goals. And in terms of guidance, I think definitely we'll be able to help you on this part. And how to stay invested. So these are 6 principles for Indian investors. So like I was just mentioning earlier, so just stay committed to your goal, not about the benchmark, or it's not about your the returns, right? So in the long run, things will do well in terms of Indian economy. Like we are fundamentally aligned well, right? Our growth rate are one of the best in terms of the top five economies, right, for the next 20 years. So the growth is actually there. So we just need to, focus on our goal, and we need to disciplinely follow, right? Once, the best time to invest when our FAs are not investing, right? They'll eventually come back and buy at higher prices. They've always done that, right? And yes, and trust your SAP horizon. So you have a 10, 15 year horizon, and you might have like I read the data. I was just reading a data that in terms of the last 20, 30 years, if you've missed like 10 or 20 days, your returns would actually be half, right? So there was a data that which said that you need to make use of the correction days, right? So if you're not investing on those correction days, if you've never stayed invested on those correction days, your returns would not be that great, right? So you always need to keep investing at different cash, I mean, different price points. So averaging is the best way to do so. And there are a lot of quotes, right, by Warren Buffett saying that, the time in the market beats the timing the market. And there is another famous quote saying that in stock market, there are decades where nothing happens and there are days where decades happen, right? So yes, so you need to, stay invested for a long time, and we need to average at each and every downturn or a downtrend. And yeah, and understand your fund's mandate. So you need to understand, which category fund you are investing. Let's say, for example, if you don't want to lose money, and you also you're a kind of an FD replacement investor, don't want to lose money at the same time, you're not looking for great returns, then BAF fund is a really good choice for you, because BAF funds generally, compounds at 9 to 10%. At the same time, you really shouldn't be looking and comparing at a Nifty 50 index or a flexi cap investor who gains 12-13% return. And you can't compare that, right? So you need to understand what category you're investing. And like I was saying, we need to review the fundamentals and not the NAV or the price of those funds. So you need to ask questions on what the fund manager style is, their investment horizon. You need to check whether they're trading in terms of inside the mutual fund portfolio, or the fund manager is actually holding the stocks for a very long period of time. And if you need to see the AUM size is very high or not, because a lot of AUM, high AUM funds have really struggled, right? Because once they reach 50,000 crores or a lakh crore AUM, then it's really tough to even buy 1-2% in a small company, right? So they actually can't buy small cap companies. Even if they are a flexi cap or a small cap company, they actually, they run it like a large cap fund. Definitely, I mean, those are very, very reputed, good quality mutual funds, but the ability to generate alpha would actually be low. Like they won't be able to do good like how they were doing in the previous decade, right? We need to ask these kind of questions and not just in terms of the past returns or the NAV, right? And you need to also, increase your SIPs when markets are going down. You actually need to be aggressive in terms of investments, right? If you are aggressive in when things are going down, you don't even need to, like invest when markets are going up, right? So let's say, for example, you're aggressively investing in 2026 and 2027. You don't even need to invest in 2029, right? So that's how things are. And definitely you can, associate yourself with an advisors like us. We can completely help you on managing a mutual fund investment. So we can, like understand your goals, right? Whatever goals you have, and you can, we'll understand your risk appetite. We'll be able to give you a risk profile questionnaire at the time you want to start. And based on these risk profile scores that you get, we'll actually, allocate funds for you. And we'll review your portfolio very often. And whenever there is a market correction, you will be getting a lump sum calls and you can participate in that. And whenever there is these themes which we are investing for you on your behalf, right? When these themes become very hot and they become very overvalued, we'll, inform you and we'll sell it on your behalf, and we'll rebalance. So we'll completely take care of your mutual funds. So the main takeaways of this webinar is that temporary underperformance is a feature. Like I was saying, right? There will Once you identify a good fund or a good team, there will be a phase where things are not going well. Things haven't moved up. It will be very silent, or even it might even go down. But this phase is definitely not avoidable. You can't avoid this, and you need to endure this phase. And once it goes up, it will go big, right? So this underperformance is something which you can't avoid. And the second thing is, whenever the Nifty has corrected majorly, when things have been very silent, the next upcoming years, right, have rewarded investors in a very, very big way. And stopping SIP at market lows is a single most wealth destructive decision an investor can make. Like I said, if you've missed investing in 10, 20 days in a decade, your returns would be very, very different than the person who invested in those 10, 20-day correction days. And yeah, and rupee cost, the dollar cost averaging will work only if you continue your SIPs when there's a downtrend or when the NAVs are falling, right? And SEBI like mandates uh, a certain replication towards the benchmark. So even fund managers are forced to do this, and due to this there will be some lags, right? And that's normal. And yeah, and like I was saying, the main thing, the behavioral gap. I mean, the behavioral gap is the difference between the actual returns the market and the fund has delivered versus the investors' returns in the same very own fund, right? Because of the a lot of wrong decisions, there will be some difference, right? So these are the main takeaways for this webinar. So the bottom line is that just want to end the webinar by saying that underperformance is the price of admission. The underperformance is the price that you pay for long-term wealth creation, right? So India is one of the world's fastest growing economies, right? So whenever there is a correction which has happened, and during those corrections, if you invested aggressively, yes, your returns can compound between 14, 16%, no doubt about it. Yeah, and during this phases when you are investing, we can actually, we can target that kind of returns for you. Yeah. And you need to always continue your SIPs. SIP is one of the very most powerful wealth building tool if you let it run. Yeah. Thank you all for joining on this Saturday morning. Have a nice weekend. Thank you. See you. Bye.